I think we're going to make a start. Okay, well, hello everybody, and thank you for joining us for today's Monitor Explained webinar, where we'll be taking a deeper dive into the fourth and final issue of Monitor 2024, which is our quarterly report that gives you an up-to-date view of current non-energy costs. A few points of housekeeping just to touch upon before we make a move. Just to remind you that this session is being recorded so that it can be shared with you after. And of course, for anyone who couldn't join us live so that they can catch up on demand. If you do have a question, please feel free to use the Q&A function throughout the webinar. We have some time allocated to Q&A at the end. And of course, anything we aren't able to answer today, we can take away after session and get back to you at a later date. Slide. So if you are a customer and you haven't got a copy of Monitor just yet, you can reach out to your account manager for a copy, or you can access this helpful guide by logging in or signing up to EDF's Market Insight portal. And that's on the address displayed on the screen now. So the Market Insight portal is your gateway to regular updates, and it's there to help you make the right decisions for the business and have access to quality data and expert analysis to help you navigate a complex commodity market. Next one. So my name is Alex Goodall. I'm an account manager here at EDF, and I'll be hosting today's session. Joining me are technical experts from the Wholesale Market Services team. So starting with David Edmonds, who's the head of pricing and valuation services. And we've also got Dan Wilkinson and Dan Minifee, both lead analysts from the pricing and valuations team. So to get us started then, David, perhaps you could give us a quick overview of what we're going to be talking about today.
Yeah, thanks, Alex. So on the agenda, we'll run through, as we have for the last few sessions of this, of going through the latest on April 24 charges of each of the charges. We'll also look a bit further ahead to April 25 and what to expect in terms of changes as we go into the next charging year there. Then also we've seen a few questions coming in from customers around EII's support levy and also the nuclear RAB funding schemes. So we'll go into a bit more detail about those and some other changes that we've been seeing over the last quarter. And then finally, we'll give a bit of an update on the inflation update from the Office for Budget Responsibility that's come through and what that means for a number of non-energy costs later in a few years' time. So moving on to start the first agenda item of overview of charges that we're seeing across the board. So running through each one in terms of what we're expecting for April 24. Some of these aren't changing too much now as we approach the end of the year, but there are some that have moved a little bit. So starting with BSUS, which is Balancing Services Use of System charges. Key update that we've seen here is we're decreasing our high range for the rest of this year. The reason for that is that NESO, the National Energy System Operator, have been essentially getting their forecast correct. So they've been collecting the amount of money that they're expecting to collect, and that's reducing the risk that they'll need to open up the rates that they've set for this winter that we're currently in. It is still possible we could see an escalation in those costs, but we think it's much less likely. So we've reduced our range of outcomes that we might see. The next one on the CFD. So we've seen a narrowing of the range on this since the last quarter. The key reason for that is that wholesale prices are the main thing that can drive this cost up or down. We've got more outturn data now that we're a few months further into the year, and we've been seeing costs outturn broadly in line with what was expected. So that range has narrowed. We have seen a little bit of an uptick in wholesale prices over the last couple of months, particularly the gas market has increased, driving up power prices, but there's not been a huge impact to CFD other than to lower it slightly. So the main effect there is just that narrowing of the range. On capacity market supplier charge, there's not much change here, and this one is mostly known. We're waiting for a bit of outturn demand data as we go through the winter and to see if any generators don't meet their contract. But generally speaking, it's mostly known at a fairly narrow range here and reasonably symmetrical in terms of whether that could outturn higher or lower. So the middle of the range is a pretty good view of the forecast that's there. One thing I didn't mention on the CFD, just to go back to that, is our best view of that is still, as we said before, closer to the higher rate there. The reason for that is that power prices can rise by a lot more than they can fall. And if power prices rise, the CFD cost decreases. So if prices can't fall that much, we think, from where they are at the moment for the next few months, that means that you're less likely to see a big increase in the CFD rate, and therefore in the range that we're seeing, our best view is closer to that high view with a smaller increase possible. Moving down to GEOS distribution charges. So these were set quite a while ago in December 22, so no change on there. FIT rates feed-in tariff. So again, this one's fairly symmetrical, so the middle of the range is the best view. We have seen a bit of a decrease in this one since the last quarter by sort of 20-30 pence or so. And the reason for that is in Q3 2024, there wasn't a lot of sunny weather, so solar generation was fairly low compared to what would normally be expected. If there's lower generation, there's lower payments that need to be made to those generators that are subsidised through the FIT scheme, and therefore that charge is a bit lower. On the renewable obligation, or the RO, this rate's now confirmed, which we've seen because of the number of ROCs that were submitted by suppliers, means that mutualisation won't be triggered, which is all as we expected it to be. So the rate is actually set ahead of time in the February before an April year. So we've known that for a little while. There was a lingering small risk that mutualisation could be triggered, although we think that is much less likely from some of the changes that Ofgem introduced over the last couple of years. So that is now all known and no risk there. Synuos is similar, so rates are set in the January before a charging year. So they've been known for a while, and there's also therefore no change there. And then the final thing to mention is that we have included two new cost items on here. As I mentioned at the start, that we've had quite a few questions on these, so I thought it was helpful to reference them in here. The EII support levy and the nuclear RAB schemes. We will go into more detail in the next section, but very briefly, just to cover them on here. The EI support levy is to compensate energy intensive industries, or EIIs, for their network charging for 60% of the charges they would pay. So that is something that was introduced a little while ago. The reason it's not been included before is we're still waiting for some of the finer details of the scheme to know exactly how it will work, what levels of chargeable demand will be, how the rates will vary, and so on. But we're starting to get a better idea now that Elexon have published a bit of data, so we can include that in here. You can see the range of outcomes that could be there. The other one is the nuclear RAB scheme, but we don't expect that to start until April 25, which is why the numbers are blank. This will be to fund the build of Sizewell C nuclear power station once that is given financial investment decision, which is expected sometime in the spring.
Cool, thanks, David. And I see you've now included some information on April 25 changes as well.
Yes, that's right. So obviously April 25 is approaching in the next few months. So as people start to look ahead and budget for those costs, I thought it'd be helpful to give a bit more detail on what we're expecting as we go into that year. So again, I'll just step through one by one and give a quick overview of what we're seeing. So on BSUOS, we are expecting there to be an increase as we go into next year. The main reason for that is actually charges this year, particularly in summer 24, were artificially lower. That was because NESO over-recovered on rates they'd set previously, and their process is to then pass those charges through as a lower tariff in future seasons. Because they've been broadly recovering in line with what they expected to across this year, we're not seeing that big over-recovery to be passed back in a later year, and that means that the charges for next year are likely to be quite a bit higher. On the CFD, this one's very uncertain because, as I mentioned before, wholesale prices are a key factor. So depending on what they do, the CFD rate can go up or down. As things stand, we do expect it to go up a little bit, and that is really because there's more generation coming through onto the CFD scheme each year, and the the strike prices the generators get go up with inflation each year as well. So the general trend of these costs would normally be to go up with inflation for a number of them. Capacity market, so that one again we are expecting to increase a bit. The main reason for that is there were previous auction costs that were higher when capacity was procured for future years. So that starts to kick in and will be a trend in the capacity market over the coming few years. There is also inflation again that indexes into that cost and increases the view of charges each year. Duos is a particularly interesting one. So the rates do vary a lot by site. Important to note that. But on average, we see the total revenues that DNOs are looking to recover next year being a lot lower than they were in April 24. So April 24 rates were very high because there had been a lot of under recovery in previous years. That was particularly in 2022 when during the energy crisis with very high bill rates for customers, we saw a big decrease in consumption. And that meant that because the DNOs had already set their charges for Duos, they didn't recover as much money as they expected to on those rates and needed to get that money back in later years. That fell on April 24, but that was very much focused in that year. So as we move ahead to April 25, there's then a big decrease on average in the charges that would come through. So that's very welcome. FIT and RO, so these schemes are closed, so they're much simpler now to look at, but essentially they are indexed to RPI inflation. So the increases that we see coming through there are broadly in line with the inflation rate that's out there. One point to note on this, one of the bigger news stories that we get each year is the RO obligation level, which is a big factor in setting the supplier charge and the cost consumers pay for the following April year. That was confirmed at the end of September. It was actually confirmed at a record high level of 0.493 ROCs per megawatt hour. But actually, because we'd seen lower inflation than was expected in 2024, our overall forecast hasn't changed massively in this report compared to the last quarter. So we're expecting that to come in at something like £33 a megawatt hour. That is an increase on the previous year. As I say, mostly driven by inflation and a bit of a decrease in demand, but not as big as it potentially could have been. Tenuos is an interesting one again. So we are expecting a big increase in Tenuos rates. Essentially, again, the total revenues that are looking to recover show an average view. It can vary by site, but the latest view is something like £5.5 billion will need to be recovered by network companies through Tenuos costs. That is an increase on the previous year. So we're expecting that to go up. And for a bit of context, if we go back a few years, Tenuos costs were sort of £3.5 billion in total. So £5.5 billion represents almost a doubling in those costs over the last few years. It's also worth noting that there is some stories in the press this week that some of the rates further ahead for Tenuos are being talked about by the network companies, and saying because of the level of investment that is needed in the transmission network to enable a lot of renewable generation to be transmitted to where people are consuming it. They are expecting a big increase in Tenuos rates and the amount of money they need to recover to fund that investment coming through. So some of the numbers quoted recently have been sort of 50 to 60 billion pounds over the 5-year period of the RIIO 3 revenue period for 5 years. That would represent again a very big increase, roughly a doubling of rates on average for the following 5 years. A lot of that is very uncertain as far as we can see at the moment. There are big investment plans that need to be approved by Ofgem still. There are business plans that we're waiting to see from some of the network companies. So it's one we're keeping a close eye on. But just a flag from April 26, that would be, there could be a further increase to Tenuos rates coming. Overall, then, it looks quite a negative picture there of lots of costs increasing. Actually, it's important to flag the size of the Duos decrease they're expected to see on average. So we do expect there to be overall an increase in charges, but it's probably something in the region of 5% or so. Whereas just looking at that picture of lots of increases could lead you to a worse conclusion than that. It will vary again, customer by customer, because some of these sites are at a specific level. But the overall picture is a small increase in total.
Okay, well, thank you for that overview, David. So turning to Dan Minifie then, I think you're going to talk us through the new charges that David mentioned.
Yes, that's right. Thank you. Yeah, I think we start with the network charging compensation scheme and the EAI support levy that David talked about earlier. So we have discussed these costs in previous webinars, but I think it's worth talking about again, as it's sort of a new cost that is coming up soon. So this scheme is part of what was known as the British Industry Supercharger Initiative, which was sort of introduced by previous government, and that has two main parts to it. The first part is an increase to the existing exemptions for RO, CFD, and FIT from 85% to 100%, and that came into force April this year. At the same time, they also introduced 100% exemption for capacity market supplier charge, whereas previously there was no exemption for that. And then the second part really is this network charging compensation scheme, which, as the name suggests, is a compensation scheme rather than an exemption. So it works a little bit differently to the exemptions just described above. And this applies just to the network costs. So Chinuos, Duos, and Basuos, or transmission, distribution, and balancing network costs from April 24. And the way it will work is that eligible energy-intensive industry companies will get 60% compensation on any of their network charging costs. But they get this compensation 12 to 15 months later. This will be funded by electricity suppliers through the EII support levy, and this levy will be based on suppliers' market share of demand from April 24, but not collected until 12 months later. We think it's going to be based on the same charging base demand as CFD, with EIIs being exempt from that levy. But we are waiting for further clarity from Elexon on some of these finer details. Elexon are the administrators of the scheme, and they have now started to publish the initial estimated levy funds for the first 3 months of the scheme that the EIIs have declared. So this is for April to June 2024. These costs are indicating that the levy is likely to be in the region of between 60 and 80 pence per megawatt hour for suppliers, but is dependent on Elexon sharing some more details with the industry on the exact charging structure before we can clearly reflect this in the bills. But yeah, the charges are expected to vary each month based on the declared network costs from the EAIs, and then also the gross demand, or national demand, on a monthly basis. But on average, we're expecting that to be around 60 to 70 pence per megawatt hour for the 24-25 year.
Brilliant. Thanks, Dan. So I guess we'll keep an eye out for any updates and let our customers know. I think you've also got an update about nuclear RAB funding as well.
Yes, that's right. You can move to the next slide. Thank you. Yeah, the nuclear RAB, again, I think a scheme we have talked about in previous webinars, but again, it's worth talking about again because it's a new scheme that is coming up quite soon. If you're not aware of what it is, this is nuclear RAB, or regulated asset base, is a new scheme designed to support new nuclear projects, and it's initially been designated for the Sizewell C project. It's technically a separate scheme to the CFD, but there are some similarities with the CFD structure, and LCCC are the scheme counterparty, like the CFD as well. So I think what we know so far from information provided to us from LCCC and DESNZ is that Ofgem will set an allowed revenue for Sizewell C on an annual basis. Normally that'll be by 1st of February each year. During construction phase of a project, the nuclear plant will receive that full allowed revenue. And that's one of the key differences from the CFD, where the CFD generators don't receive any subsidy payments until they actually start generating. Whereas with nuclear RAB, they start receiving payments during the construction phase. And then later on during operational phase, the nuclear plant would sell power into the wholesale markets, and they would receive a seasonal market revenue. There will be a difference payment from that market revenue to the allowed revenue, which could be a positive or a negative payment. The initial allowed revenue and levy rates will be triggered by the final investment decision, or FID, for Sizewell C. Initially, that was expected by the end of 2024, but that has now been pushed back into spring next year, as per the latest government autumn budget announcement a couple of months ago, which means that we're not going to see any payments until that point, until after FID has been confirmed. So then the LCCC, Low Carbon Contracts Company, they will set a quarterly interim levy rate, or ILR, and a total reserve amount, like we do with the CFD. But for the nuclear RAB scheme, there will be 30 days notice from the point where they set that levy for suppliers to start paying. The initial levy rate that will be set will be triggered by FID, with final investment decision, and then Ofgem setting the allowed revenue. So this means really with the kind of announcement to the delay of the final investment decision, we're not expecting any RAB payments before April 2025 at the earliest. And then once that final investment decision has been made and Ofgem have published the allowed revenues, the levy will be set by LCCC, and that will be calculated as essentially a kind of a flat allowed revenue payment over the quarter divided by national gross demand. And again, we expect the demand charging base will be the same as CFD, with EIIs being exempt from that payment. At the end of the quarter, the levy rates will be reconciled to a daily level, similar to the CFD, and this will be based on the shape of actual demand. But the payments to the RAB payments to the nuclear plant will kind of remain flat over the quarter, but there'll be some shape with demand. Things we don't know yet are the expected costs of the scheme. There has been a wide range of numbers sort of being floated around. DESNZ have committed to provide a forecast at some point, but we haven't seen any kind of public domain forecasts yet. We don't know exactly when it's going to start, although we have a little bit more certainty now that it seems like it's likely to be around springtime. And we don't really have a good understanding of the detailed calculations of how that allowed revenue is going to be set by Ofgem. So yeah, I appreciate sort of still some unknowns there, and it's not ideal because obviously it could start soon without too much notice and without too much insight of the magnitude of those costs. But it is something we are monitoring closely, and we'll keep you informed probably at the next Monitor webinar.
Cool, thank you, Dan. And are there any other policy changes affecting the charges that are worth mentioning?
I think, yeah, probably the main one is SOMBUSIOS. There have been a couple of modifications recently approved. So as was previously known, it was CMP 361 was introduced an ex-ante fixed BUSIOS tariff, with tariffs being set for 6 months at a time and with 9 months notice. That's been the case since April 2023. But just recently, Ofgem have approved 2 new modifications, CMP 408 and CMP 415, with implementation from April next year, 2025. So CMP 408 sees the notice period being shortened from 9 months down to 3 months, and CMP 415 means that the fixed period is changing from 6 months to 12 months. However, separate tariffs will still be produced for the summer and winter, as is the case now, but it's just that those will be set at the same time. So the impacts mean that, or the impacts of that are that the summer 25 tariff that has already been fixed, so that's not going to change. The winter 25 tariff is due to be announced later this month, and that's not going to change because implementation of these modifications isn't until April. So that means the first new tariffs we expect to see under these new modifications will be in December next year, and at that time we would expect NESO to publish the summer 26 and winter 26 tariffs both at the same time. The idea behind these modifications is to create more stable pricing and to allow NESO to hopefully have a more accurate forecast, as they have to set rates less far in advance. We'll see winter tariffs continue to be set in the preceding December, as is currently the case, so that doesn't really change. But the summer tariffs, however, will be set closer to delivery, so they'll be set in the preceding December rather than in June.
Okay, thank you, Dan. So turning to Dan Wilkinson then, I think you're going to take us through the last topic of inflation.
Yeah, thank you, Alex. So yeah, inflation is something that feeds through into almost all of the non-energy costs in some shape or form. We track outturn inflation as we go through the year, but twice a year we get a report from the Office for Budget Responsibility around what their view is of inflation over the next few years. That forecast will feed directly into the forecast for our non-energy costs. It varies by non-energy costs because different non-energy costs use different inflation metrics. So some use RPI, some use CPI, and there's a difference between each non-energy cost as to what period they use to index inflation year on year. So a couple of examples. So for example, FIT, that inflation forecast or the view of inflation is used to index up or down if inflation ever went negative. The tariff that will be paid out to FIT scheme users, and that will feed directly into the cost that energy suppliers need to pay into the FIT scheme. So FIT will be indexed based on a snapshot of the December RPI. So we'll be looking at in December 2024 what the inflation has been over the last 12 months to the preceding December, and that will be what feeds into the rates for the following charging period, or the April 25 year. Others, so for example Tenuos, where we receive fixed tariffs that are set in February for the following April. That uses a mix of outturn inflation over the previous 12 months and a mix of forecast inflation for the remaining period, and that uses CPI rather than FIT, which used RPI. So there's a bit of a difference between different non-energy costs and what inflation they use and how they index, but on the whole most use inflation to allow revenues or their tariffs that they pay out to end users, which ultimately ends up with the suppliers paying a higher amount into the scheme if inflation is a positive value. Their latest report that they published in October, compared to their March forecast that we received earlier in the year, has a higher forecast of inflation for the coming few years. That feeds through directly into our forecast of what those non-energy costs will be for the next couple of years. So overall, that has generally led to an increase in those views of cost, which would have fed into our high and low range in our non-energy cost forecast that we shared earlier in the slides. Over the 2025 period, they're relatively small increases. 2026, perhaps slightly higher, because there's a larger period where the forecast is expected to be a little bit higher than it was in March. Yes, those have fed through into our latest forecasts. That's the update on inflation.
Okay, well, thanks for that, Dan. Well, thanks to all of our and obviously that brings us to the end of the prepared content. We've now got some time for some questions, so if you haven't done so already, please feel free to put your questions in the Q&A function, and we'll hope to answer as many of them as possible. We've already had a few come in, so I think we'll make a start on those. Perhaps David, one for you. So this is, so what impact will the new Labour government's net zero plans have on non-energy costs?
Yeah, so well, I guess one point in general in terms of not necessarily net zero plans, but policies in general, as Dan just covered on inflation. So the OBR's inflation forecast is published at the same time as the budget announcement was coming out at the end of October, and I think generally reflects a view that the measures are inflationary, and that's why inflation has increased. So that will feed through to a bit of an increase in a number of the non-energy costs that come through. I guess more specifically on net zero, I think one of the areas is obviously increased renewable generation and accelerating those plans. Currently, the CFD scheme is the main way to deliver that. So we may well see an increase in the cost that comes through there, but that does depend on where strike prices get set and where market prices go to when those actually start generating. But yeah, I think if you need to build a lot of infrastructure like that, there's likely to be a cost there somewhere. And that would be the subsidy scheme that delivers it. If you're going to have more renewable generation, I think then you need to think about the networks. So if there's no more investment in the networks, if the capacity wasn't increased massively, it would feed through into higher balancing costs and BSUOS you would expect to go up to manage that extra renewable generation. If there is network investment to stop that happening, then that's also going to have to be funded somewhere. So GEOS and distribution charges may be an area on local networks, so there might be extra cost that's needed there over the coming years. And then, as I mentioned earlier, on to NUOS, we're already starting to see in the increases that we've seen in recent years, but then also some of the commentary in the press coming from the network companies that we could see quite big increases from investment needed in the transmission network. Yeah, so as I mentioned before, a few years ago, around £3 billion a year was recovered. Next year, we're expecting about £5.5 billion to be recovered. And then some of the stories talking about £60 billion over 5 years from April 26. So yeah, we could continue to see quite a big escalation in those costs as it comes through. I also noted that a question came in while I was mentioning that before around whether the increase into NUOS would come through as in the residual charging as opposed to locational. Currently, that's what we would expect. That would be the mechanism that we'd expect those charges to flow through. Obviously, that there could be reform of those charges. And REMA is looking at some network charging. That there's other charging reform that is being considered across the industry. But yes, currently, I think the expectation would be residual charging and standing charges might be how those get reflected.
Okay, and just kind of carrying on the TNUoS point, is there much increase to TNUoS charges from the recent draft tariffs? Maybe Dan, Minifee.
Yeah, I can take that one. Yeah, so I think we published this in the monitor report. The NESO, National Energy System Operator, published the draft 2025 TNUoS tariffs at the end of November. And in that, they have published an increase to their total allowed revenue of around 235 million compared to their previous view that was published in July. So that, as David said, that total allowed revenue is now standing at £5.5 billion for 25 year. Most of this additional revenue is coming from increased transmission operator income across the different transmission network operators across GB. And most of that additional revenue is going to be added to the non-locational demand residual element of the Chinos cost, which does make up the majority of Chinos costs. So that's the pound per site per day cost. That gets that varies by voltage level and band. So most customers would see an increase to their residual cost arising from these draft tariffs, but that impact does vary significantly across those different voltage levels and bands, and some tariffs may even possibly see a small decrease. Locational tariffs have also gone up a little bit from the draft, from the previous view that was shared. Again, that impact does vary quite a bit by region, with some regions even seeing a decrease. But those locational tariffs do represent just a small part of the Chinos, of the total Chinos revenue. Yeah, and then I suppose final point really is that those are just the draft tariffs at this point. So we are expecting the final tariffs to be published in January. So there could still be some movement up or down from this latest draft announcement.
Okay, perfect. Thanks for that, Dan. Next question then. So is there a likelihood in the future that new to earth PPAs could be made exempt from RO or green taxes, etc., in non-energy costs? David, perhaps one for you.
Yeah, I saw that one come in. It's not something I've heard of specifically from a policy point of view, but it's an interesting idea. I guess probably not answering the question directly because I don't know, but some related points I think of. I mean, first of all, PPAs themselves, the generators don't pay a lot of the non-energy costs anyway on generation, but I think the question is probably looking at corporate PPAs and the interaction of PPAs with supply for businesses. I mentioned REMA earlier, which is the review of electricity market arrangements. There is some sort of consideration of corporate PPA markets in there, whether they need any oversight reform. So there possibly could be something that comes out of that, or I don't think we're expecting there to be huge changes there. I mean, there are some sort of existing license exemption type arrangements as well, but they're generally quite small. That are out there already, and I'm not sure there's a big policy intent to increase those as well. Some of the areas that there is some focus on it, hydrogen producers, so that they are listed as energy intensive industries, so they get quite a lot of the exemptions that we've been talking about. So that kind of area, it's not really a PPA in the same way, but it's not unrelated in terms of delivering some of the net zero ambitions. So that could potentially create a pathway for some of the PPAs to look at something similar. And then I guess also there is wider discussion around the industry of should to encourage electrification, a lot of these costs be removed from electricity bills more generally, maybe put onto gas bills, maybe put into general taxation. I think it's being mentioned. There's a lot of uncertainty about it, so unclear at this point of whether that would actually happen and when that would happen if it does as well. Yeah, a few things that could potentially lead towards that kind of suggestion that's in the question.
Okay, thank you, David. Just looking through a few more of the questions. One that sticks out. This question asks, will the method for collecting the EII support levy be one of forecast rate and then an actual rate? So i.e. initially bill a forecast and then be reconciled at a later date? Take us for that.
I think this is one where, again, we're still sort of waiting to see some of the finer details. The rates that are being published at the moment, I think, Dan, are more indicative and will potentially change still before they actually come to being billed to suppliers and consumers. So I think that concept of there'll be an element of a forecast rate and an element of a final rate is probably right. Yeah, I don't know, Dan, have you got anything else to add?
Yeah, I think Elexon published the estimated levy funds, which I think comes from what those EII companies have declared. I think there is room for EII companies to submit corrections to that but I don't know if that would have to be done if that gets reconciled at a later point. We're not quite sure on some of those sort of final details yet, but yeah, it's quite possible there may be some kind of adjustment or reconciliation with actual costs.
Okay, well, thank you for that. Sort of a couple more questions, or in terms of terminology, I think. One question is asking if we could provide a written summary on the non-energy charge impacts. I guess we might have some material coming out in the not too distant future, monitor. And somebody else asks if we have a glossary that we could include, because there's obviously a lot of acronyms within this. So perhaps, I don't know, David, have we got a glossary that can be used so that our people can better understand the acronyms? I'm not sure.
I don't think we have one in general. We can share, but we could look into producing something, because there are definitely a lot of acronyms in this industry. I guess we try to sort of explain them as we go, but some of the ones that we've talked about frequently we might not have done. I guess I encourage you to reach out to sort of account managers, and we can help if there's particular ones you're unsure of. More than happy to help clarify on some of those details.
Perfect. Perhaps one last question then, and that is, what is the legal basis of using electricity prices to cross-subsidize industrial users for EII?
So I don't know about the legal basis. I think the policy intent is because in Europe, the sort of competing on international industries, competing companies aren't subject to the same charges. So the intention is to allow GB companies to compete on an equal footing by removing some of those charges from their energy costs, where they are energy intensive and use a lot of electricity. So that's the rationale that's coming through. The mechanism for doing that is to then make others pay the cost that they are not, and that's why charges then go up for other consumers as an amount. But it's a relatively small amount of demand being smeared across a much larger amount of demand, which does mitigate some of the impact, but clearly there is an impact there.
Okay. I think we might just do one more question that's just popped in, a short one. So regarding the NCC compensation scheme, you mentioned that DUOS, BSUOS, TNUOS is applicable. And asks, do we also include available capacity charges in our claim?
I don't know the specifics. I don't know, Dan, if you do.
I mean, my understanding is any part of the DUOS costs or the network costs, I would assume yes, but not 100% certain, but that's my understanding.
There is, I'm sure we can find the link and share it around. There is some guidance that has been published, I think by Elexon for energy intensive industries of the process they need to go through to submit their claims in there. So I'm sure we can dig that out and share that around to who asked that question.
Okay, perfect. Well, I guess that brings us to the end of our Q&A. Thank you to all of you for your questions, and obviously thank you to our presenters for sharing their insights today. Next slide, I think.
So I think there might be a couple of questions on the Q&A. I don't know if we've covered those or not.
A few more have come in, have they? Okay. No, I think there's just an acknowledgement of the reply. I think we can, unless I'm missing anything, I think that's...
I can see everything. There's one question, is there a list of those companies that are EIIs? I'm not sure there's a list of the actual companies, but I think DESNZ of government do publish like a list of eligible sectors that can apply.
Yeah, a list is maintained, but I'm not sure it's publicly available. But you say those industries and sectors are somewhere.
Okay, so I think that's all the questions. Don't think I've missed any more. Brilliant. Okay, I think next slide then, David. So just to wrap up then, so we'd obviously encourage you to take a look at our program of webinars across the year. So these are there to keep you informed on the latest power market and NEC updates. You can register to attend any of these by heading over to edfenergy.com/large business and clicking on the Talk Power events page. So before you go, obviously we'd love to hear your feedback, as this helps us to continue to deliver the right content for you moving forward. If you could give us a minute of your time and click on the link in the Q&A chat function to complete a quick survey, we would really appreciate your feedback. And finally, obviously, if we didn't answer any of your questions today, please feel free to get in touch. Our details are on the screen now, so you can contact us using the email provided. And obviously, you can stay in touch with all the latest industry news and updates from EDF by following our dedicated EDF Business Solutions LinkedIn page. So once again, well, thank you very much for joining. We obviously wish you a very happy festive period, and we look forward to seeing you in the next quarter. Thank you very much.
Thanks all.
Thank you.
Thank you very much. Wait.